Good evening. Welcome back to Hurdle Rate. For this video, we're going to be building a DCF from scratch for Nike. As you can see on the chart here, Nike has taken a bit of a beating over the last few years. It's almost down 2/3 from its peak of about 180 in 2021. So there's been quite a few changes in the company recently, a new CEO, a new strategy. So let's see if there is value in the stock and whether it could be a good buy or not. So first of all, as we always do, go to the SEC website, pull up the latest 10Q and the latest 10K, which is down here, and pull them up. Nike's full years in the summer of 2025. So we're now in the earnings releases for 2026. So it does its annual year is in the middle of the year rather than at the end. So yeah, that's just a note. Let's pull up a spreadsheet, page layout, remove grid lines, view, freeze the first column, come to the A, insert another one, make A smaller, make B larger. If you just format the A column and just go center so that it's we can put an X in there to indicate the start of a new section. But okay, so let's start with. Actually, do we want to put the ticker up there? I'll zoom in a little bit for you. So A1, put NKE, which is the ticker for Nike. Go data stocks. There we have it. That's one. Then go here, ticker, date, go. Format it like that. And we want for this one, it's the current share price. This one implied. So copy these two boxes over. Then we want to know if there's any up or downside. So we have it. The ticker equals A1 dot, open the parentheses, ticker symbol. The date today is the 7th of November, 2025. Current price equals A1 dot, open brackets, price. Okay, leave these two blank for now. Let's go here. Do a bit more formatting. This blue font. Go. And in this section, we're going to do our assumptions. We're going to break the company down into revenue segment. We're going to, if you're on this, if you've opened up the 10K, come to page 33. We're going to break down the revenues by these footwear, apparel, equipment, global brand divisions, Converse, and corporate. I'm going to leave a space, make it cleaner. Footwear. Apparel. Equipment. Global brand divisions. Then we have Converse and corporate below. The top, we need to write switches. Then we're going to put bear, base, and bull. And it will become clearer as we're building this model out, but we're going to simulate between positive and negative scenarios. The bear case is a negative scenario, the base is just what we expect to happen, and then the bull is we're being optimistic. Up here, copy this formatting down, pull it to here. Now copy all of these, just bring them down here. Put a 2, because that's our base case. These switches we're going to toggle between 1, 2, and 3. So leave it on 2 now, and when we set them up, it will simulate the base case scenarios. Then we want EBIT, WACC, EGV, terminal growth value. Copy these two and put them below. Then copy these like that. Copy a blank one here. And 3, go there. Have it. Okay, so that's our assumptions section built. Now we can actually go on to the numbers. We start with the revenue build. We're going to be starting this in 2023. And that's because normally in previous ones we've done on this, we've started in 2022 because most companies haven't filled their full year for their 2025, their fiscal year. But for Nike, the fiscal year ends in the middle of 2025. So we can start in 2023. Go +1. Wait, what are we doing? False. +1. Then just pull all of this along until 2030. We only have 1 quarter of 2026, so we're going to treat that as if it is part of the 5-year outlook. So for the first revenue segment, we go footwear. Below that, we want to know what the percentage growth is going to be. Then we want the bare base full percentage of revenue. A bit, okay. Go number, remove the decimals, use a 1,000 separator, and for negative numbers use bracket. Okay, so for 2023, we did 33,135. And these are in millions, so the revenue for 2023 was just over 33 billion. 3347 for the following year, 29510. To work out the percentage growth, you just take the year that you're in, divided by the previous year, -1. There we have it. Pull it along. And for 2026, we will see they did 7 billion in footwear in the first quarter of Nike's 2026. So that is 7410. Let's see what they did last time, 7462. So we will divide it by 7462. Let's go 7410 multiplied by 3.95470383. So we'd be anticipating another drop in revenue for this year. And that sort of makes sense because they're having to almost like rebuild the company. The previous CEO wanted to have more of a D2C focus, whereas he broke all the relationships with like I guess Dick's, what's the other one, Foot Locker, Macy's, and the new CEO is trying to rebuild all of those back. How do we? Yeah, let's do it like this. We'll only forecast 4 years out, but we will still use the cash flows from this one. We're going to use the multiplier method. Well, when we multiplied what the ratio was for 2025 by the same quarter, and we'll do that, but we'll still include these in the cash flow. So let's do it like this. But we anticipate a return to, let's say, it comes back up to 6% growth. So make this cell equal to this one. And for this one, let's say it does grow. It returns to growth next year. Let's go, it goes 2%. And to work out what the two in between here are going to be, we go equals minus, open brackets, the previous cell minus the final, close brackets, divided by the final year minus the previous year. So let's see what we need to lock in here. We always need to lock in this column, but not the row, because when we copy and paste, we want it to adjust. The 2030 is always locked in, then it's always the row locked in here. Oh, always does that. Column width, put it back to 10. Let's just make this to 2 decimal places. 2 decimal places. Or percentage 2 decimal places. There we have it. Why is this not working? Wait 1 second. You know what happened there? Try it again. Let's just redo it to make sure we're getting it right. So we take the previous year minus, open brackets, the previous year minus the final year, divided by the final year minus the previous year. So we want to the column, but not the row, then the column and the row for the year, then just the row for this one, because we want it to slide dynamically. Okay, perfect, it's working now. There we go. And so a bear case scenario, let's say that is 90, let's go 95% of what we've said. The bull case, 105. So we take the base, multiply it by the bear case scenario, lock it in, pull it across. We do the same for here. We take the base. No, sorry, that's not right. We take the base, multiply it by the bull, lock the bull in, pull it across. Bit of it actually. There we go. Looks good. For these here, we're going to use the offset function, which allows us to flip between these different scenarios. So we will go equals offset. The cell that we're in, G27, the switch, which we lock in, then comma, then close the bracket. Just format it to make it look the same. And there we have it. Now to work out these four, all we do is we take the previous year, multiply it by 1 plus the switch, the growth rate, enter, copy it across. Now we have our revenue build for the footwear. I remember these figures here because I'm going to show you. We're going to simulate. First, we'll go to the bear case. See, it comes down a bit. Back to base. And then we're in the bull. So it's not that much. It's not that much because we're only going 95% of the base and only 105% on the bull because I don't think we can be too. I don't think it will be too extreme for such an established company. Okay, so 20. What do we do now? We're going to onto apparel. Just copy all of this as so. Change this one equals B11, so it says apparel. We'll just enter what we see here. 13,843, 13,775, 12,965, and for 2026, they've done 3 and a bit billion so far. The same time last year, they did 3032. So that's actually improving. Divided by 3032, 4.276. So let's do 3313 multiplied by 4.276055. Okay, so this could actually look quite good for the next year. And we'll say, well, let's say it does another, let's say it goes 10%, but it eventually settles on 5% growth. Equals G11. So it does look like apparel can recover a bit faster. I think, oh, 1 second, we do need to get this right though. Just copy these down here. Make sure each switch is on the right. Copy this, put it across, paste. Yeah. Change this to C11, put it across. There we have it. This is a, come back, let's keep everything on base. Okay, that looks good. Basically, what the previous CEO did, he tried to expand the gross margin by going to D to C, but then obviously that has a lot of marketing costs on your operating expenses. And then I guess he burned those bridges with the major retailers, which sort of left the company in the mess that it is at the moment. So yes, equals this equals B. Yeah. Well, no, not plus though. Okay, so for they did 1727 2075 2191 2026. They did, we say 630 for now. So three by this same time last year. Or 630 multiplied by 0.634992. Okay, but let's say it goes up again. Let's say it goes up 4%, and we'll put that to. Okay, let's go 6%. Maybe we put a parallel up to 6%. There we go. 12. Let's change all of these to 12. Good. Next one is this global brand divisions. Oh, okay. Yeah, okay, easy. So these two, no, sorry, this one. B13, and so 58, 45, 48. In the grand scheme of things, the next, well, converse will, but global brand divisions and corporate are very, very small in comparison. So we don't have to worry too much about them. Divided by 14, 3.42, so equals 9 divided by 3.42, 85714. I mean, this can stay at 2. We'll just leave it at 2%. There's no need to worry too much about that one. Yeah, it looks good. The next, this one is, I think it's 14, converse, back to, where are we? 2427. converse is how does this work? Oh, 501. For the previous year, 3. So 366. Okay. Again, we'll go for a 2%. Maybe somehow comes back to growth. What did we say? Equals G14, is it? Yeah, good. Okay, looks good. Now it's just this one last section called corporate, which is not that, and again, it's a bit like the global brand divisions thing. It's not a very small part of the revenue, but we have to put everything in so that it all lines up. 7 minus 42 minus 7. Then what was it for plus 23? Minus 8 multiplied by 4.73913, and we'll just put this at 0. And there's not really a point in trying to make it be like a bull bear case on this one, because it's so small. Keep it at 0 there. Yeah. Pull this along. Yeah. There we go. Yeah, that's it. That's the revenue build. Well, we've just got to do a total. Let's put a border, just put a hard line. Go total revenue, put it in bold. Go equals sum. We want to take this one. Just each line, we just add it to the there we go. Fold it, copy and paste it all the way along. Then we want to know what the revenue growth is. Yeah, okay, it looks good. So we're anticipating a recovery. We're going to say, look, it's not going to be great this year, but in the subsequent years, we'll start seeing that take place. Once they got rid of the excess inventory, they're returning to more sports focus rather than lifestyle. We're going to see them come back to, I guess, doing what they're very well known for. But I mean, from here, I mean, you can see as a footwear brand, they are. I mean, they must be the largest in the world. This is astronomical, doing 30-odd billion a year just from footwear. But obviously, there's some big rivals that are coming in, taking a market share. Hoka on running. You've got Mizuno, you've got Asics, Adidas, all of them. There's it's a very competitive space, but obviously Nike is the is the top dog in this space, but it might not be for much longer if it keeps going this way and it doesn't return to its what it did so well for so long. But the new CEO is so on this next point, go income statement. The new CEO is a lifelong. He's worked all the way there from being an intern right up. He's retired, but now they brought him back in as a CEO, so he does know the company probably better than anybody. Okay, so you go revenue, make it equal to total revenue. It's important to always make this equal to this, especially as we're going down, because that way everything can link up dynamically or sync dynamically, whichever way we want to look at it. There we have it. The next we want percentage growth. The next section we look at is the EBIT. We want to know what this is as a percentage of revenue. Then we want the taxes paid for the year, because we're doing a free cash flow to the firm. So we're looking at how much cash flow Nike will produce for both the debt and equity holders. So to find this information now, let's go into the 10K first. Where do we find it? Not on consolidated revenue. We want it. It will be on here, income before. Let's see if there's whether we want it on the main financial statements. 90. It's 91 or 52, so let's have a look. Here we are. Income before income taxes. So we have to add back in these two. So we want it as earnings before interest and tax. I have it. Okay, yeah, we just add back in the interest expense. Maybe not this one. We don't know what that is. The other, but yeah, we do that. So we go for 2023. We find 6201. We add back in 6 equals 6201 plus 6. Equals 161. Equals 3885 plus 107. And really, you can see here just how their margin has been really hurt over the last couple of years. So yeah, for 2026. Okay, let's find it. Oh, we could have gone to this one, consolidated operating. Yeah, okay. So if by this time last year they had done 2.95. So if well, this is quite strange because they only made 4 billion, just under 4 billion in EBIT for the full year last year. But in the first quarter, they did 1307, which you would think that means they would do just over 5 billion. So, and that didn't really work. I think it must have been because of the excess inventory. Okay, but I think let's say it's going to be the same for this year, because it's not seen as people aren't very optimistic about it. For now, we're going to do an EBIT simulator later, but just do an average of the last 3 years. You do that by going equals average, use this formula and take the last 3. And we just go the revenue multiplied by the EBIT margin, which is the percentage of revenue, and put it along. We'll tax it. So this one, income tax expense, 1131. Work out the margin, the tax rate, sorry. You take the taxes divided by the EBIT. 1,000, 1,000, 6. For 2026, let's have a look. Okay, remember this for later. 21% is the effective tax rate. 13256. 6. Go 195 multiplied by 2.60. 15625. This down, put it along. We do your EBIT multiplied by your EBIT. Okay, that's the first part. Now the next section are the cash flow items. These are depreciation and amortization. I want to know is a percentage of revenue. Percentage of CapEx. Then we want the change in net working capital, change in NWC. We also want to know what that is as a percentage of revenue. These are, we need the full financial statement. So on the 10K, so the 10Q, here's your balance sheet, then you have your income statement up here, then you have your balance sheet. If you actually look, I mean, the inventory is increasing, which is it's usually not a good sign. So yeah, here we want depreciation and amortization, additions to plant, property, and equipment. And this is the change in net working capital. We do the sum of these. So, but let's start in the previous year. So 2023. 703, 796, 775. CapEx is down here, 969, 812, 430. Change in net working capital. So the sum of these, we just go equals sum 489, comma, negative 133, comma, negative 644, negative 225. Okay. Same again for 2024, equals sum negative 329, 908 positive, negative 260, comma 397. Same for 2025 equals sum negative 257, comma 120, comma negative 224, comma negative 426. Yeah, let's just get what the get the percentage of revenue. Very small. Work out as a percentage of capex. You just divide it by the so. Okay, move on to 2026. So by for the first quarter of 2025, they did 188, so 775 divided by 188, 4. Okay, equals 190 multiplied by 4.122. For capex, 207, so they did 430 divided by 120 by 8, so equals 207. To forecast these out, we'll just take the average of the last few years multiplied Okay, the fact that changing net working capital is negative bodes well for future for free cash flow because it shows that they have favorable payment with their suppliers and that the suppliers could give them say 90 days to pay and they could actually sell the inventory within that time. So yeah, looking good. We're going to move on to the DCF now, the actual DCF. And then after that, we'll have to build a weighted average cost of capital, the WACC, and the cost of equity. But once we get to that, we'll solve that problem later. But it is quite good because Nike does break down its revenue by region, so we should be able to get a good sense of what the equity risk premium is. What am I doing? No, sorry. Okay, just copy the EBIT down to 2026. Put it to there. What we want to do is one of these down. Put it here because we need to know the percentage of revenue there. we will say this is an average, and we will forecast it to go to, let's anticipate that this will go to 13% by 2030. Which 17. And again, we just have to do use our offset function. We go the cell that we're in, G101. Taxes, percentage of EBIT. Pull these across. Now, again, we just do an average. We have it. Go EBIT multiplied by the tax rate and pull it across. We want this so that when we simulate different scenarios on the EBIT, it will adjust the tax accordingly. Go. Okay. In this next line, we want to calculate the EBR, the earnings before interest but after tax. And we're going to take this 2026. We're not simulating it, but we're going to use that one for the cash flow because it's nowhere near a full year. It's the problem when you're doing valuations in the first quarter for a company. But the EBR is your earnings before interest but after tax, and you take your EBIT and you subtract the taxes. Simple as that. Go. Now, we go back to our depreciation and amortization, CapEx, and change in net working capital. We just copy them down from what we did up here. Just copy this formatting again. Go. Now we can calculate our unlevered free cash flow. Bold. And all that is you take your EBR, you add back in depreciation and amortization because it's a non-cash expense. Then you subtract your CapEx and you subtract your change in net working capital. And because this is negative, two negatives make a positive, and there we have it. Then just copy that along. And these are our cash flows that we're projecting for the next 5 years. We want to find the present value of the unlevered free cash flow. Here, just put a 1 here, and you'll see why later. Go 1 to 5. Okay, so what we need to do now is, this is the unlevered free cash flow for the next 5 years. We need to work out what the present value of these figures are. To do that, we build a weighted average cost of capital. And the reason we're doing that is because of the time value of money. $1 today is worth more than $1 tomorrow because of inflation. There's the possibility that say revenue is not generated, so we have to attach a risk rate to that. And to do that, we build the WACC. So open up another sheet in your, okay, let's see, take off your grid lines, make your A smaller. You don't have to do anything beyond that though. I'm going to zoom in. Again, put Nike in your top left-hand corner, stocks. Make this one bigger, and we're going to make the weighted average cost of capital, which is the WACC. And what this is, it's the percentage of equity multiplied by the cost of equity plus your percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. And to do that, we need a few components to work this out. We need the market cap, we need the percentage of equity, we need the cost of equity. And the cost of equity is the risk-free rate, the beta, what's the other one? The equity risk premium. Then we want we want to know the debt, percentage of debt, cost of debt, tax rate. The total here, then put WACC. So market cap we can get quite easily. Just a little bit wider. We go equals A1 dot open parentheses market cap, but make sure to divide it by 1,000,000 so that it's only showing in thousands in the same way we've done on the other spreadsheet. So Nike is an 89 and nearly a $90 billion. The percentage of equity we can't work out yet because we need to combine the market cap with the debt to get a total. Then we divide the market cap by the total, and that will give us our percentage of equity. We then do exactly the same with the debt. So we leave that one for now. Cost of equity we can't do. Risk-free rate we can. We come on to here and we go home, bonds, 4.077 is our risk-free rate. It's the US 10-year. The beta we can't work out yet. The equity risk premium we can't work out yet. The debt we go onto the balance sheet. Nike currently has, we'll go notes payable, but it doesn't have any short-term debt. But long-term debt, it's got nearly $8 billion. So we go equals 7,961 plus 5. That gives us that's the debt for the company. So this is a majority equity company. We now know what the total is. We go market cap plus the debt, meaning the percentage of equity is now the market cap divided by the total. Do the same for the debt, percentage of debt. So it's nearly 92% equity and just over 8% debt. Cost of debt we can work out in that's the next one, to be honest. But yeah, we want to find out the interest expense. Not on this one though, we want it over here. $18. Let's just do 18 multiplied by 4 divided by the debt, and that should give us .9%. Yeah, I guess it will. Then I think it was 21.1% for the effective tax rate. Found that. Yeah, here it is, 21.1%. Yeah, we'll use that. Plus, it doesn't have 21.1%. It doesn't really matter. I mean, it does, but it doesn't really matter that much because Nike is a majority equity company. It's what we do on here that really matters. So to work out the beta, we need to break Nike down into the industries that it operates in. To be honest, I think we're just going to go with. So if you haven't already, go into the Demoder, Aswath Damodaran's website. He's the professor at NYU, and you can download his betas for different industries. We're going to say, I mean, we're going to say Nike is apparel. I don't think we can really go much. Yeah, that's probably, yeah. There's not really another section for it. So yeah, we'll do that. We'll go with apparel. So do we go in industry? We want the unlevered beta for that industry. Then we want revenues. Then we need revenues. Then we want the EV to sales. Then we want the value. What would the next one be? Proportion. Yeah, then we get the weighted beta. I mean, to be honest, we don't really need to go through all of this because it is just one. We're only using one industry, so it's going to come out as 0.69. But I'll just show you the. Unless we want to put electrical equipment, no, fitness. There's no, isn't a. Not really a home furnishing. Recreation. Maybe we go for this one, retail special lines. So yeah, we'll do it in two so that we can get a so I can show you the methodology. The unlevered beta for apparel is 0.69, and for retail special lines, 0.96. The revenues, we go equals apparel. Just take plus apparel, so footwear plus apparel plus Converse. Then you just ignore those last two. They're not really relevant. And retail special lines, you just go gym equipment. Maybe yeah, just do these for sake of it. Go EV to sales. Come down. So this is the beta spreadsheet. We now want the price to sales data. We just want apparel, retail special line. And it's this number we want, 1.41 or 1.07. 0.07. To work out the value of the company, you just go revenues multiplied by the EV to sales. Just copy that down, take the sum of these. Now the proportion, you just go value divided by I didn't lock it in, so just do this. Go to 2 decimal places though. Now the weighted beta is you just go the proportion multiplied by the beta. Get down, go sum, 0.7. Oh, no, didn't work. And that's our beta, 0.7. What's the cell? H26. In my previous videos, I built out a nice sheet for the cost of equity, but just for time saving here, we'll speed through it. But yeah, in the future, if you want me to go and do it how I was doing previously, I can do. Just let me know. Now, we want to know what the equity risk premium is. We need to break Nike down by where it generates its revenues. So we have that here. So we go region, revenues, ERP, weight, and then weighted ERP. Let me just put a and pull this up. So the regions, we're going to go North America, Europe, Middle East, and Africa, there, Greater China, and then APAC and LATAM. So the revenues for North America are, okay, this is what we want. 52, sorry, I was on the wrong year. 5020 3331 1512 1490. Sum of these. The ERP. So the ERP for each of these now, we put up this spreadsheet. So the North America ERP is, where are you? .58%. That includes Canada and the US. Canada is 4.21%. The US is 4.61%. So it's 4.58%. Then Europe, Middle East, and Africa. Here we are, 6.22. Just so you know, this hasn't been updated since the middle of the year. So I think the 1st of June. He will release his next one. Usually, I think within the first fortnight of January. So yeah, make sure you download that one and update. Right now, it's not necessarily accurate to real time. It's based on the figures from 3 or 4 months ago. But yeah, that's it's good to take into account. China will just use China here, 5.25%. Now APAC and LATAM. Do we do this one? Okay, we can just go we will take out these lines. Caribbean will keep, Central and South America. We'll take out Africa. We have that in EMEA, APAC, Australia, New Zealand. That counts as APAC, I think. So yeah, 6.41%. Remember that number because I don't want to. 6.41%. Forgot to put China in 5.25%. So the weight is you just take the revenue divided by the total revenue, but lock total revenue in, so we can just put it down. The weighted ERP is just you take the weight multiplied by the ERP. There we go. Then you just go sum 5.26%. F36. Have it. So now your cost of equity is equals your risk-free rate plus your beta multiplied by your equity risk premium. So let's do that. Equals risk-free rate plus your beta multiplied by your equity risk premium. 7.76%. Now we have everything that we need to calculate the WACC. So let's do it. We take open brackets, percentage of equity multiplied by the cost of equity, close brackets, plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate, close brackets. Equals, so 7.19% is what our WACC is. Come back over onto the other sheet. We go equals. Let's just, what do I want to do? Let's just put all these to 2 decimal places so it doesn't. Yeah. So your WACC, we just go equals. Where is it? Here. And your terminal growth value we're going to say is 2.5%. Let's format here. There. So your bearish WACC, the greater the WACC, the more bearish you are. So we're going to add 0.5%. For a bullish WACC, we're going to take away 0.5%. For a bear case terminal growth rate, we minus 0.5%. For the bull case, we add 0.5%. Now, we want to be able to use the switches on the WACC and the terminal growth value. But we're not going to use the offset function, we're going to use choose. So equals choose. Now just all of these in the order that you can see them. Oh, I don't know why that D1 is there, but that's it. Copy the formatting. Put it down to there. Okay, now we're almost done, guys. Go down. To calculate our present value of unlevered free cash flow, you take the unlevered free cash flow and you divide it by 1 plus the WACC, close bracket, to the power of the year. So remember we wrote these down here. We do it like that. Lock in your WACC because we never want that cell to change when we're dragging it across. There we go. Yeah. Now your terminal value is you take the final year of the free cash flows and you multiply by 1 plus the terminal growth value, close brackets. You divide it by the WACC minus the terminal growth value. It will come up in a second. I don't know why it is so slow. And we want to know what the present value of the terminal value is. And we just go the terminal value divided by 1 plus the WACC to the power of that final year, which is 5. Once we have the present value of the cash flows and the terminal value, we can calculate the enterprise value. All this is you go sum equals sum, you take the present value of the terminal value, and all of the present value of the free cash flows that we forecasted. Okay, now we want to add back in the cash. We want to subtract the debt to get the equity value. The cash, okay, we know the debt because we've got it for the WACC. But for the cash, we need to come onto the balance sheet. Where is it? Here. So we can go, we add these two, 7024 and the short-term investments, 1551. Or 7024 plus 1551. The equity value is you take the enterprise value, you add back in your cash, you subtract your debt. It's fairly, I mean, they're fairly similar because the cash and the debt seem to be balancing each other out. Equity value, diluted shares outstanding. And from there, we get our implied share price. So diluted shares outstanding are here. We don't use basic, we use the diluted because if they have to issue, say, stock-based compensation, then it's going to increase the share count. So yeah, 1479. The implied share price is you take your equity value divided by the diluted shares outstanding, and there we have it, $88. So J132. And to calculate the upside or the downside, you take the implied divided by the current minus 1. So yeah, I mean, on the base case, there could be a 45% upside. If we come back to the share price on the graph, the chart, yeah, but let's just flick through some different scenarios. So the bear. So the bear is saying it's about just under $70, which, if we look at for the last year or so, I mean, it's sort of been going in this range between 80 was a peak. What would it be on the bull case? 7. 117. So you know what? There could be some good upside to this. Play with your own numbers and see what you get, because I mean you're all going to have different forecasts from what I've done, and if you might be like, hang on, no, I don't think the EBIT margin is going to go back up to 30%. I think it will settle at 10, and then obviously that would change the implied price. That would put it at 72, which you would say, actually, you know what, it's not far off fair value now. But yeah, I think if the turnaround can happen and revenue can return to growth and the EBIT margin improves, then there's certainly a considerable amount of potential upside for the company. So yeah, let's keep an eye on it, and we'll see what happens. Okay, well, thanks for listening, and we'll go on to the next one. I'm thinking I'll do Uber next and Novo Nordisk, because those are the ones that have been asked for in the comments. But if you have any suggestions, please do let me know, and please do hit subscribe. Thanks for watching. Bye.